Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Quick note, if you missed any of the content from the Planet MicroCap Showcase Vegas, I've uploaded all the keynotes, panels, and webcasts from the event to our YouTube channel, so be sure to check that out. And as I mentioned last week, our next event will be the Planet MicroCap Showcase Vancouver, taking place at the Fairmont Waterfront on September 6 and 7, 2023. More information to come, but for the time being, see you in Vancouver. My guest on the show today is Howard Punch, President and CIO at Punch & Associates Investment Management, Inc. Punch & Associates is a boutique investment advisory firm that has both a small cap and microcap equity strategy available for their clients. I invited Howard on to learn more about their equity strategies, his firm's approach to investing in microcaps, as well as their investing philosophy. We also chatted at the top of the conversation about how he would compare this current pessimism in small microcaps to other times in history where this pessimism existed. His take I found really interesting. And also, as the title states, we did spend the majority of the time talking about categorizing MicroCap CEOs as either missionaries or mercenaries, and how deciphering between the two has helped Howard better understand which management teams he wants to invest in. Thank you again for tuning in to the Planet MicroCap podcast, and please enjoy my conversation with Howard Punch. Everyone, to the Planet MicroCap podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me right now is Howard Punch. He's the president and CIO at Punch & Associates Investment Management. Howard, thank you for joining me today. How are you doing?
Great. Thanks for having me, Bobby.
Absolutely. It's great to have you on. I feel like we have met at one of these conferences along the way, but, I've known the Punch & Associates name for a while, and I really do appreciate you taking the time here to jump on and share some of your insights, it broadly in terms of what's going on in the macro as well as what's going on in the micro here. But, I want to start here, just digging right in, if you don't mind me saying, we could talk, we could BS, but might as well get right into it.
Right.
From your Q3 2022 newsletter, you published your review of small caps. I'll assume that we can, we can throw microcaps in there too, right? And the title of that article was Small Caps Down But Not Out. I think we can all also agree that the last 12 to 18 months has just been an absolute SHIT show.
A lot of my clients would call it that. Yeah.
I got two little ones, so my spelling out of curse words has gotten really good.
Okay.
So, I mean, from your perspective, how would you compare this current pessimism in small microcaps to maybe some other times in history where this pessimism existed?
Yeah, it's a good question. We do pay a lot of attention to sentiment. I think in that newsletter, I brought forth a racetrack analogy, hypothetical situation where you're going to the racetrack, and for some reason you happened upon a sure thing, a horse that was absolutely guaranteed to win. And so what conditions would you want so you could maximize the return on that insight? And I put forth that number one, you'd want all the other participants or bettors to think that your horse does not have a chance. And then secondly, you'd want them to focus merely on the favorites, betting all their money on the favorites. And the point of this little anecdote is that your level of return has a lot to do with how others are betting. And so if you're right on this particular horse, you make a lot of money. Now, of course, when we turn to the stock market, there are no sure things. And for small and micro caps, what we have right now is we have skepticism. So we have this disbelief that anything can work out there. And so we have the necessary, if not sufficient conditions for the start of maybe a good period for small caps and micro caps. So to your question on pessimism and how does this rank in history, the last 20 years, I don't think anybody would call it a normal period for the stock market. You had the dot-com blow up. You had the great financial crisis, Brexit, global pandemic. But over this time frame, large caps delivered, just under 10%, and the Russell 2000 delivered just under 9%. And so it's somewhat in line with history. There's been periods in history where the stock market has experienced a general pessimism where people seem depressed or pessimistic about everything, and they don't think anything will ever recover. And then there is a period, or there are times when there's specific pessimism, or what I might call frustration, where an asset class is lagging. The smaller caps would be the asset class I'm referencing, and they've lagged materially in the last 5 years. I think the index for the Russell over the last 5 years has returned 3 to 4% versus 11% for the S&P. So this has contributed to a frustration or an attitude that I'm just going to ignore this asset class until it starts treating investors better. 2008, the great financial crisis, was perhaps, for me, having been in the business 40 years, the most persistently and pervasively pessimistic I've witnessed for the general investment community. That was everything. That was small, that was large. It was a no place to hide environment. Even if you own bonds, muni bonds, any non-government bonds, you lost money. Right now is not like that. Investors right now seem to be hiding out in 5 or 10 of the large tech companies and doing just fine. They're kind of like the favorites at the track right now. And small caps and the S&P 490 index is leading investors to frustration and maybe a higher degree of localized pessimism. So the small cap bear market started in November of 2021. So it's, call it 18 months old. MicroCaps started at the top of the meme boom, March of 21. So it's over 2 years old. So back to your question is, how does it compare to history? Well, there are big differences. I would probably compare this period to late 2002 or 2003. Back then, small cap investors were licking their wounds from a dot-com debacle. There were a lot of negative enterprise value companies. Today, there's a lot of fallout from past sins like the SPAC boom, some bad IPOs, too much money going into non-mark-to-market vehicles like private equity and venture. And now we get the banking crisis where we see little optimism creating what we think are some pockets of opportunity, and some good companies I think are getting painted with the same brush as the bad companies.
So quick, one follow-up to everything that you just said there, because this is a more recent example that I've seen where, because I hear that, and I think, and I tend to agree with your opinion that, now is probably a time where you want to, probably bet on your better names, right? Maybe look a little bit more closely, maybe allocate a little bit more. Like if you don't want to be in full cash, like maybe look at the names that you really know well, you feel confident in the long-term strategy. But there was an example actually recently of a company that by all means, everyone was like, okay, here we go. Here might be our next MicroCap winner, doing some things, executing on the strategy, big acquisition, year over year growth, profitable, the whole, all checking all the boxes, right? And then the following week, after I think it was announcing the closing, they do a money raise, they do a capital raise, right? And that kind of sometimes eats in the craw. There are some other reasons why I think that bothered some investors that I know very well, but at the end of the day, that also kind of eats in your craw. You're like, really? Like what, why, what's going on? And so I'm going to ask this in a different way than maybe you'd expect. Do you blame management of these companies that maybe know that they're kind of hitting on all those metrics and they're like, you know what? Stock's gone up a little bit. We're kind of one of the favored names out there in microcap. We have the retail support. Like, why not raise capital right now? I'd love to hear your thoughts there.
Yeah, I mean, I do blame management. I do. They have a constituency. They should get to know their investors. They should, in some ways, inkle that they're going to do something like that. It should not come as a surprise to.
That was the problem. It was a surprise.
And it's not surprising that corporation is going to raise money when they can. That's when they should raise money. But it definitely, if you're a young company, what you're banking on is your credibility over time. And so you have to back that up by following through with your actions, what you say. I mean, in short, I do blame management.
Yeah, I tend to agree with you, especially in the fact that it was a surprise, right? Mm-hmm. But then I try and think of like, okay, well, let's play devil's advocate. Like, well, did they just think like, you know what? It's not the worst thing right now. Like stock's up, 100% over, in the last 3 months. Like, why we could probably use this maybe to pay down some debt. Why not? So I can see that side, but you're right. When a company is that young, it's all about credibility at this point.
They're going to need new shareholders. It's a new story.
Yep. That's right. Well, no, it kind of gets to my next question because, on one hand, you're thinking to yourself like, all right, I really want to, especially when you're looking at micro and nano caps, you're like, okay, I want to find the good ones. I want to make sure that I'm invested in those, right? Maybe that, you've done your own due diligence. You see like, okay, this fits all my criteria. You maybe see some other folks that are in it. And you're like, okay, like I respect their opinion. We talk with them. You're like, okay, going to size up, here we go. And then like something like that happens. So, when we talk about, a better margin of safety, in times like these, when looking in micro and nano caps, I mean, why is it still now not the time to bet against small micro caps when these kinds of things might happen and continue to happen?
Well, they are going to happen.
No doubt.
There's no question about that. But I would tell you, when you look at the index performance for small and micro versus, large cap, the last 10 years of performance for small and micro contradicts the previous 100 years. The long-term FAMA French data will tell you that the smallest 3 deciles of the market outperforms the largest 3 by a pretty good margin over the time. And the last 5 years has really done a good job convincing people otherwise. So if you analyze the return stream of small and micro caps, you're going to notice that the reason small and micro is outperformed is because it comes in 3 to 7 year bursts, usually after a period of underperformance, which we've just seen. And I can't tell you when it's going to start, but for the moment, you can see the money goes to where it's being treated best. And that's been in the 7 or 8 of the largest tech companies. But if everybody owns the same stock, who's left there to buy it. Many of these companies are the same ones that led when we had zero interest rate policies, and now T-bills are over 5, and the 2 years over 4%. So if we're dependent on these companies, I don't think we're going to be in a general bull market. So at some point, I think we need new leadership. But our small cap strategy has 21 years of history, is trading at its lowest valuation we've ever seen in 21 years. And we believe the lower valuation and solid balance sheets is what creates kind of a quantitative margin of safety. We get the concerns around the threats of a recession, cyclicality, but don't think that our valuations should be lower than where they were in the great financial crisis, or the dot-com blow up, or a slew of other crises that we've kind of managed through the last 20 years as a firm. And the last point I'd make is, according to Fury Research and Morningstar, small caps of all the major asset classes have received the lowest amount of inflows since the great financial crisis. So this includes bonds, international, domestic, some things that have done worse than small caps. So nobody plows headlong into an asset class at the bottom of a cycle. This is, to me, the behavioral margin of safety right now.
Absolutely. I mean, you took the words right out of my mouth. I mean, I just had it anecdotally that, the inflows have been the lowest they've ever been, just from talking with various buy side. In fact, we had, I don't know if you know Acuitas, but we had them do a presentation in Vegas because, a lot of PMs and buy side are looking for, all the various avenues for potential inflows, even from the institutional side. And so it's actually pretty fascinating when you think about, well, okay, how do I construct a strategy, especially if you have a smaller fund with less assets to deploy? It's like, what do I do from there? Do I just, stay as I am? Do I sell off maybe my, tier B, maybe not so much my tier A stuff? How should I think about it? I mean, as you were growing your strategy over the 20 plus years in your experience, I'm sure you had those times too, where you had to think to yourself, all right, this is kind of a rough waters right now. Maybe you have some advice for those folks out there.
Are you talking about the unexpected outflows, or?
Yeah. Yeah.
Yeah, we've been fortunate. We've been real methodical in our growth. We've attracted good and loyal clients that understand what they're getting into when they're getting into a microcap strategy, and understand the illiquidity of the vehicles. We've explained to them why owning illiquid vehicles over the long run can generate better returns, but it's also going to generate outsized volatility, outsized drawdowns. And so I think you need to have a good match between timeframes between the manager and the clients. And it's got to be more than a legal thing. It's got to be a true understanding of what it is you're doing and why you're doing it.
100%. So I want to actually take a couple steps back here, Howard. For those that don't know you and Punch & Associates, I'd love to get your background. When did your passion for investing begin? And then also what led to you launching the MicroCap strategy at Punch & Associates?
Yeah, great. Well, going back a long time, I started at a large wirehouse in an era in Minnesota where you could buy 10% tax-free municipal bonds that were insured. It was hard to get clients back then. For me, I was young. I wasn't a great salesman. So once I got a client, I didn't want to lose them by picking bad stocks. And I was conservative with other people's money. Clients started to ask me about stocks. So I decided I should try to figure out how to pick them. So I didn't know what I was doing. I listened to the company research, and I decided I was going to take the plunge and buy a stock for a few clients. The first stock I bought was for clients was RCA. It went down almost immediately. I went back and reread our firm's research. I ordered the 10Qs and 10Ks back then, which came by snail mail. I tried to figure out where I'd gone wrong. And the market had just simply pulled back. And as you know, GE eventually bought RCA, and things worked out with that particular stock. My experience over the next few years was hit or miss. I didn't really have a philosophy. I listened to stock tips. I read newsletters. I read the company research. I tried to figure out what I liked or didn't like, and I just made a bunch of mistakes, and I didn't really make clients much money. And in the late 80s, I had back surgery. Unfortunately, I was laid up for like 4 months. It was invasive surgery at that time. I decided in looking at what I was doing in the business that I was going to need a philosophy that told me what to buy or sell, what to hold, and why. And so I went to Barnes and Noble and bought a bunch of books, and I read. And I read the classics, but I enjoyed William O'Neill's book, How to Make Money in Stocks. He was the founder, as many of you know, of Investors Business Daily, and had the acronym that for stock picking that was called CAN SLIM.
Yep.
So he had a concrete system for identifying companies that could be winners. The S in SLIM stands for shares outstanding, which according to his criteria was 30 million shares outstanding at the time. I don't know what it is now, but that led me to small caps. But there were things about his approach, his strategy that I didn't like and didn't scale for a money manager, and or maybe good for a smaller money manager or somebody that managed their own money, and I would endorse that, but it didn't work for a money manager. And I read Peter Lynch's book. It just made a lot of sense to me. I liked the practicality of his approach. He investing in things that you knew. I liked how he divided his companies into silos, like stalwarts, fast growers, slow growers, turnarounds, etc. And it seemed more like an all-weather approach that would work for me over time. And we do something somewhat similar in our approach. And Buffett's quoted a lot, but I think Peter Lynch has some of the best quotes that I continuously recite to my team and to clients. He said, if you spend 13 minutes a year on economics, you've wasted 10 minutes. And the other quote that I love is, you can do very well in the stock market. All you need is 2 stocks per decade. So think about that. To me, that takes all the pressure off. 2 stocks per decade. You don't have to do something every day. And I think Buffett would agree. It's you take away Geico, Apple, and a few others, and Buffett's probably underperformed the S&P over his lifetime. So it's really a good point that a quote that stood the test of time. So eventually, I decided that I enjoyed finding and owning little-known companies that had a revenue stream and that was attached to a profitability stream. That I felt like I could understand that, and I like to find them when their expectations were low or even non-existent. I also concluded that I couldn't sleep well at night unless I got to know the management team and what they viewed as their place in the market and what their vision was of the future. I owned a lot of stocks over the long term. If you own a successful company for 5 or 10 years, you're assured to get a 40 or 50% drawdown a few times over that 10-year period. So those critical moments, you need to have confidence in the management team, and you need to have access to them. So you asked me what attracted me to MicroCaps. It was a game that I thought I could win at. It was one of the great things about, I think, small and microcap investing is that you're not competing against great macro minds, huge teams that Soros or Tepper or Griffin have. I think Buffett has suggested a number of occasions that he could attain greater returns if he was a microcap investor. That's really what attracted me. I'd be curious what attracted you.
Yeah, no, I mean, it was very much, well, one, it was part of my family's business. Well, my father was an investment banker over 25 years. And
Okay.
and he made a market in over 300 stocks. So for me, I was kind of, I was having cereal and hearing about this latest IPO or
Oh,
something.
great.
So like I kind of been in it for a very long time, but really only, but you know how it goes with family business sometimes, or, you don't take it seriously until like a little bit later. So once when I was in college is when I started really being like, okay, this is actually super interesting and I really love it. And,
Yeah.
kind of, it was also pretty easy when like the first job they had me doing was looking at cannabis stocks while still in college. Like that doesn't hurt,
Yeah.
they're all dogs, don't get me wrong, but it was still,
Is he still around to feed you ideas?
yeah. Oh yeah.
Okay.
He won't stop. And thinking about you talked about sorry, not to change back to what we got going on here, but we were talking about Vegas. We just we made merch for those who are watching on the video version here, but we were just talking about Vegas and management teams and talking with management. I mean, the whole point going to a conference like ours is actually conversing and meeting with management, talking to them over drinks and getting to know the real who they are, because you're going to be investing in them, and especially in microcaps in many respects. So for you, I mean, over your, I guess now it'd be 30, 40 plus years doing this. I mean, what are your main criteria when you're evaluating management that makes you feel comfortable in wanting to hold that company for that 5, 10, maybe even 15 years?
Yeah, when I initially meet them, I'm trying to figure out whether they're missionaries or mercenaries. And missionaries, they have a purpose that goes beyond the money at the corporation. They have a responsibility to their shareholders. They have a responsibility to their employees. They have a responsibility to their clients. And it's something that they would almost do for free. And so ideally, that's what you're looking for when you meet these people. And you got to get at that. Sometimes you can get at it through like a really well-written shareholder letter. But typically, you're not going to get at that until you have some conversations with them. And ideally in person, if you can.
I mean, are there any questions that you like to specifically ask management? I mean, we have another show on here called the Due Diligence Series where, I think I asked the majority of the questions that almost every investor in a one-on-one or, having time with management will probably ask. But I mean, everybody is different. And sometimes, you have a certain question that'll give you a certain cue about that CEO's character or not. I'd love to hear if you have any specific questions in particular that you like to ask management, whether it's the first meeting or maybe the fifth meeting.
There's none of them that occur to me like right off the bat, but it's nice when a CEO can be honest and vulnerable, and when you can get them talking about their biggest mistake that they made and what they would do differently. We also try to ask them about their competition and who they're afraid of competing with and why. And so sometimes we get other ideas as a result of somebody saying, I sure hope this guy doesn't compete with me in this area. It tends to get us to want to make another phone call. So, but there's a ton of questions we ask that just come up at the spur of the moment in conversations. We try to ask mostly open-ended questions that they can take anywhere, and that leads to more open-ended questions, and it leads to kind of questions that you'd want to know that have more to do with culture, how they treat their employees. You can get at some of this through looking through a proxy and seeing what the incentive systems, priorities are, and or you can look in a 10K and you can see, stuff like related party transactions and stuff that will scare you away from a particular company. But there's just a lot of open-ended questions that tend to change from company to company.
Very true. All those questions that you like to hear are also the same ones I hear. I at a conference, I think 4 years ago, it was the first time I finally was, I was in one of those group settings with management, and everyone's throwing out questions. And before the CEO was even prompted, he said, "This is where we fail. This is how we will fail." Like a full slide dedicated just to that. And that immediately earned my respect. Like that's the good stuff right there. Because even whether you care about the company or not, like at least now okay, well, all right, you're spelling it out for me. Like this makes my job that much easier because we're always trying to protect our downside.
That's a good point. That's a great slide to keep.
Yeah, I think I'll have to check his most recent presentation. I don't know if he kept it, but I think he kept it for a while. So, I mean, now I'm assuming your investing philosophy hasn't changed, maybe a little bit tinkering here and there and whatnot. But, as we're recording this on Tuesday, May 9th, 2023, when you think about potential new ideas right now, what are you looking at? Maybe that's specific to the time period we are in right now, or just maybe in general, and how you're applying all of that.
Yeah, the best investment philosophy needs, I think, in some sense, to be timeless. It's going to work during certain time periods, and it's not going to work, and that's what makes it a philosophy. Any investment philosophy that needs to narrow down the universe of what you're going to consider. It's not, for us, it's not always clear what we will buy, but I think it's pretty clear what we won't buy. And the North Star for a firm like ours is profitable and under the radar. With select firms, we don't necessarily have to be contrarian or make a great macro call. We just have to be early. We love it when management tells us as we visit them that nobody from the buy or sell side, has visited them, in years, and that to us is music to our ears. And the other point I make is importantly that we've really added over the last, I would say, 10 years. Is the philosophy that returns on capital is greatest where capital is most scarce. And there's a great book called Capital Returns that is written by a group out of London called Marathon Asset Management that talks about this concept. And so we tend to avoid areas where a lot of capital has recently flowed. Cannabis might be a good example of an area we would avoid. Just because of all the capital that's flowed into it. We need to understand a company, how it makes money. Lots of companies for us end up in the too hard pile. Profitable, I talked about profitable. It may sound boring, but if you screen the Russell MicroCap Index right now, only 36% of the companies are EBITDA profitable over the last 12 months. So you can eliminate 2/3 of your stories. And, the best stories for a new investor are usually come or belong to unprofitable companies that are going to change the world. Most of our companies are not going to change the world. We have stats that we've compiled that show, not surprisingly, that holding only profitable small cap companies outperforms, since inception, the Russell 2000 index. And I believe that's since 1978, and it's not by a little. People talk about catalysts with under the radar companies. The best catalyst is just long-term execution. It gets companies noticed, and eventually you don't need like a concrete catalyst. It's going to be increased earnings, increased revenue. The other piece of our philosophy is management matters more in smaller firms than a larger firm. It is the toughest thing to evaluate, but I would tell you, for me, it's the most enjoyable thing to try. I talked about CEOs and missionaries over mercenaries. Founders can be good or they can be entrenched. We will often have half a dozen conversations with the management team before owning shares, and somebody on our 8-person investment team is going to be in constant communication with firms we own for our clients. So we're a value manager, so price matters. Many times we have to take a temporary pass on firms we like a lot just because we can't access the liquidity at the right price. And then finally, we tend to start small and build a position as our conviction increases.
Absolutely. Thank you for all that. I hope I might just clip it because I thought that was really good. But I wanted to dig in also the idea of when you're looking at microcap management teams, and we talk about that a lot on the podcast. Especially microcaps made the point already. You're basically betting on the jockey at this point. But I like this idea of how you categorize it of missionaries versus mercenaries. That's really fascinating. So I want to dig into that. So, now looking at mercenaries, because that's a difficult thing sometimes to really decipher, because you might have, a mercenary hiding in missionary clothing, if I may, where, if I could go on the analogy where, they might have, they might own a significant stake of the company and yet have an incredibly high salary, right? And it ends up being a piggy bank / they own a lot of it, so they can kind of really do what they will and not care potentially, So I'd love to get your insight there of the various types of, mercenaries that can be out there that are disguising themselves as missionaries, if I may.
Yeah, I think I wrote an article about this several years ago, and I can't recall the substance of it, but my example for a typical mercenary CEO was Chainsaw Al at Sunbeam Corporation, and he came in there and basically commanded a huge salary because he executed some turnarounds in the past and basically looted the company, and so that's kind of like a wolf in wolf's clothing. So it's kind of an easy one to spot, and I'm not going to say that a mercenary CEO cannot make you money. They can. I'm just simply saying that I will sleep better at night if I can identify someone that really cares about every constituency at the company, that cares about their reputation long term, that is setting up the company long term, that cares about the employees long term, that cares about the shareholders, that is not just focused on his stock options, but is focused on sharing the success of the company throughout the company. And I do think that can be identified, maybe not right away in the first meeting, maybe not even in the 6th meeting, but over time it can be identified. And when I look at the companies that we've held for 10 years, 5 to 10 years, I have to say that most of them have missionary-oriented CEOs that we've identified and said, okay, we can sleep at night with this guy at the helm. He's going to do what's right. And he's going to do what's right for the long term. We may have a 40 or 50% drawdown like we would with a mercenary company, but we're still going to be able to hang in there with them.
I mean, you don't have to name a company when I ask this question, but I'd love to hear an experience that you've had where it was basically a learning lesson where you were really starting to kind of categorize, okay, this is how I want to be thinking about management teams. I have the missionary camp, mercenary camp. I'd love to hear an experience that helped you, really figure out this categorization. Again, you don't have to name the company or even describe, but I'd love to hear some kind of anecdote.
Yeah, I'll give you a fairly recent example. We own a medical company that was experiencing some degree of success. We've had several conversations with the CEO of this company, and we noticed that he a year and a half ago, took some of his holdings and liquidated them in a secondary transaction at a fairly good double-digit price, and he said it was for estate tax purposes, and that people need money for that purpose. But he was getting a decent salary, and he had historically shown that he was willing to go into the open market and do an insider transaction on the buy side in the past. And we had asked him, after the stock had a pretty substantial pullback, he was commenting on the quarterly call that the stock is really cheap. I can't understand why the valuation is there. And we got on a separate call with him and said, "Why are you not buying your own stock? I mean, you've done that in the past." And he said he was locked out. He said he blamed it on the lawyers, and that went on for a couple of quarters. He never bought it, and and the stock blew up again. And so, to me, that was where he kind of lost me. It happens in the small and micro cap space. We're big boys and girls here. We can take our medicine, which we did, and move on.
No pun intended there.
Right. So, but that was a recent example, and fool me once, shame on me type of thing.
I think probably the greatest lesson that you shared from that story is just, try and do your best out there, everyone, to take management at their word, and also from management side, like if you're going to say, you better friggin' do it, because right. You will lose people pretty immediately, right. especially if you lose them money. But one other question on the experience side of things, we talked about, lessons learned from creating this categorization of missionaries and mercenaries. But is there any other, you mentioned RCA at the beginning of your career, is there any other investing experience that you would say really changed your career or guided you towards how you think about microcaps today?
Yeah, I think as a general experience, I had one I bought a stock in a company in the mid 80s. It was a company that I had just started to do my own independent research. And it was a company that made several acquisitions, but became known for being the primary manufacturer of weenie casings, cellulosic casings for things like sausages and hot dogs and stuff. And it did quite well. And it became a large holding for my clients at the time. And it was one of my largest personal holdings. Unfortunately, I learned what can happen when you hold a stock on margin during the crash of 1987. And so the experience taught me a couple of things. It taught me about the rewards of doing your own research and developing your own conviction. But it also taught me a little bit about risk management and, to size your positions appropriately, and also maybe not use margin.
Yeah, wow, that sounds like another podcast for another day. Learning about that. Well, Howard, we're pretty much there. We covered a lot of stuff. I mean, is there anything else that we haven't covered, or things maybe you want folks to, take away from this interview, just either in general, maybe an outlook? I love to hear your kind of your final take here.
Yeah, I mean, it's a great space. I mean, I really get up. I don't skip to work, but I get pretty excited to come to work and to dig in and to find the next big winner. It's like a great Easter egg hunt every day. You're looking for trails that lead you to successful investments. For new investors, I just tell you to get started. It's a wonderful space. I live in Minnesota where it gets quite cold in the winter, and we like to say it keeps the riff-raff out here. Minnesota is not for everybody, and I would say microcap investing is similar. It's not for everybody. As a professional, you can't be focused on huge AUM numbers in this space and also enjoy success. But to me, that's the good news for smaller funds or smaller investors. They can enjoy an advantage. For new investors, I'd say, just pay attention to what you're attracted to, where you might be a little bit off balance. And as you learn about investing, you should also be learning about who you are as an investor. And I'm in the business 40 years, and I'm still learning. We have owned a small medical company for almost 2 years, and it's been okay for us. It hasn't blown up or anything, but I just told my team the other day, we're the wrong owners for this company. And so you just kind of come to that conclusion, and sometimes it takes time. I would say also to new investors, be skeptical of narratives. The best ones are usually attached to the least profitable companies and are too easy to find. And I would say successful investments are found. They usually don't find you. So if they find you, be skeptical and keep a journal, write down your thesis and why this company will do well, and then revisit it periodically to make sure that the thesis still holds. And then I'd just say read a lot and listen to podcasts like this one.
Oh, I appreciate that, man. Thank you. You didn't have to do that. I appreciate it. Well, Howard, by the way, I love that phrase. Your best investments are found and they don't find you. That really, really rings true. Well, with that, Howard, where can our audience go and find more information on Punch & Associates?
Yeah, I'm not big on Twitter or anything, but we're at www.punchinvest.com. You can dig into our newsletters that are out there and commentary. We got a great group that takes a lot of time to write these articles on a variety of different topics, from wealth management to income investing to small and microcap investing.
Very cool. Well, Howard, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I really look forward to our next update.
You bet. Take care. Thanks, Bobby.
Podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.